So, welcome to today's presentation. My name is Peter Yosef, Senior Market Analyst at IronFX. In front of your screens, you have your USDs for our chart. All charts to be presented are to be of the same time frame, unless otherwise stated. We're going to be mixing technicals with fundamentals. What you're seeing right now is me actually working already on the Euro USD chart. I'm making some readjustments. And actually, I have adjusted the ultimate resistance line at the peak of our chart, and that's at the 1.1135 resistance level. You can see the label here actually characterizing it. Now the peak has been reached, and that was on the 28th of December. It's been practically all the way downhill from that point onwards, maybe with the exception here where there was a relative stabilization in here as well. Yet the bearish tendencies seem to have been reignited for Euro USD, and at this point it would be interesting to see whether we have a downward trend line guiding the pair, and actually we seem to do. So I would expect for the time being some bearish tendencies to be intensified. On the other hand, we have to note here that the price action of the RSI indicator has remained between the readings of 30 and 50, which implies a residue of a bearish sentiment in the market. Yet, more or less, that sentiment seems not to be that strong. So for the time being, there is an interesting catch in the sense that we have a series of lower peaks and lower troughs, a downward trend line, but the price action seems about to test it. Now, for the time being, we have to reverse the role of the 1.0830 from a support line to resistance line. And let's go hunting for a new ultimate resistance support level, Dragging the R3 now downwards, and this is the level in my opinion, yet that's pretty wide. It's still valid. You can see how there is 1 touch, 2 touch, 3 touches, 4. That seems to be pretty good. Another solution would be this level here, where you have this continuous support here, while there was also some resistance. Okay, let's break it. I don't want to take the S3 too far lower. And at this point, I would be noting in green the 1.0570 support line. Locking it in, readjusting the chart. Now, fundamentally, actually, the euro has pretty much weighing on it, given that we had the release of Germany's and France's preliminary GDP rates for Q4. Practically, the releases tended to verify that Germany is in a recession, and actually that tends to more or less threaten the whole area. Let's correct also labels so we have a clearer view. It's important for you guys to have a clear view when actually trading. You have to be able to grasp the direction and the possible targets within a glance. That's it. Locking everything in. So for the time being, we tend to maintain a bearish outlook as long as the downward trend line remains intact. In that case, we definitely expect the pair to create a lower trough than this one On the other hand, we have to note here that for Euro USD to be able to mark a lower true than this one, it has to breach the lower Bollinger Band, something which may be an obstacle. And in that case, we may see the pair starting to aim for the 1.0740 support line. Now, that's a level which practically provided support back in early days of December, actually in the 8th to the 9th of December. You can see it very clearly how it reversed an intense downward motion, and we have a nice U movement here. Back to the chart. Even lower, we note the 1.0655. On the flip side, should the bulls take over, I would expect the price action to breach the upward trend line in the first signal that the downward motion has been interrupted. But at that point, I would also require the pair to breach the 1.0830, which is expected, but also the 1.0925. Yes, ladies and gentlemen, I would require a higher peak than this one before calling in the bulls here, with the next possible target for the bulls being the 1.1010, a level which provided resistance back here. You can see how it has halted the intense upward movement of the pair around the 14th of December, 14th to the 15th of December. While and there is another peak of the chart, is right here, as we have mentioned, at around 1.1150. Let's have a look again, once again. 1.1135. Okay, let's delete this. Let's have a look at USDJPY. USDJPY has maintained a sideways motion between the 146.30 and the 148.60. Now allow me to readjust the level of the first support a little bit higher, reaching the 146.60. That would practically render us a corridor within which the price action is moving of around 200 pips. The rest seem to remain untouched and valid. I would like to see once again where the second resistance line actually rests. The first resistance line is clear that it rests on one peak, two peaks. It was tested, not clearly broken. They're valid. Let's have a look at the R2 though. Okay, there's a nice resistance level here, and there are three here. Okay, I'm keeping that. Let's readjust the chart. Widen it a little bit, just to be more visible. So for the time being, we tend to maintain a bias for the sideways motion of the pair to be maintained. I would be noting, though, that the release of the summary of opinions of BOJ for the general meeting more or less did not seem to have an effect yet. So I would expect the pair to maintain the sideways motion between the R1 and the S1. I would, though, also be highlighting the possibility of a bearish outlook, and that would be happening should the US dollar start weakening, in which case we may see USDJPY actually breaching and having a lower true than this one. So that would mean a breach of the S1 146.60, and the pair starts aiming for the 144.45. On the flip side, should the bulls take over, we may see the price action rising, breaking the R1 148.60, and start aiming for the 149.70. Let's have a look at GBP/USD. Also in sideways motion, pretty wide one, but still, yeah, that's valid. And you can see how the Bollinger Bands have narrowed, exactly highlighting practically low volatility for the pair. which may allow the sideways motion to be maintained. Also note how the 100 moving average and the 200 moving and the give me a sec. Yeah, and the 200 moving average, that's the green line and the orange line respectively, have flattened out and are running in parallel, more or less highlighting a relative stabilization of the pair. One small issue though, which should be mentioned, is that the price action of the RSI indicator seems to be constantly dropping. Let's show a small downward trend line here. Yep. So practically the bullish sentiment has faded away, and now a bearish sentiment seems to be slowly but steadily building up, which may more or less allow for bearish tendencies for the price action as well. Should the bears take over, for bearish outlook, actually I would require low show than this one. I would require a clear break of the 1.26 support line, which is also the low boundary of the current sideways motion. And in that case, next possible target is being set at 1.2445. Mind you that cable is going to be a very interesting pair this week, actually starting from tomorrow onwards, as we have on Wednesday the Fed's interest rate decision, which is expected to affect the USD side of the pair. On Thursday, we get BOE's interest rate decision. And we'll talk about that on Thursday when the time approaches, which could affect the GBP side of the pair. And on Friday, we have the US employment report for January, once again affecting the US dollar. So it's going to be very interesting how cable will be reacting to all of this, and whether a bearish outlook will actually be materialized. Now, on the flip side, should the pound start strengthening, or if you prefer the US dollar weakening, both apply, in that case we may see GBP USD rising. Yet for a bullish outlook, I would require a higher peak than this one. So the price action has to break the 1.2779 resistance line, which also forms the upper boundary of the current sideways motion. I would require, though, a clear break. A mere jump above the R1 is not enough. We have to see the price action rising, breaking the R1 1.2779. Actually, that should read 77. Let's have a look. 80. Yeah, that's better. And has to break the 1.2780, and in that case, I would like to see the level actually being used also as a support line. That would be, in my opinion, a verification of the upward movement. And in such a case, we may see an upward trend line starting to be formed and allowing us to see also the limitations of an upward movement. Let's have a look at USD CAD. USD CAD, which is edging continuously lower, has broken the 1.3410 resistance line, now turned to support. Let's switch that into a resistance line. Let's go hunting for a new ultimate support level. A beautiful touch right here. That would be in green, the 1.1390 support barrier. Let's readjust the chart, reposition the labels. There you go. So we start by lowering the R3 at 1.3675. R2 at 1.3540. R1 at 1.3410. S1 at 1.3320. S2 at 1.3180. And S3 at 1.3090. Now on a technical level, sorry, on a technical level, the bearish outlook seems to be pretty intense. And I'm highlighting this practically based on three reasons. A, you see that there is a clear-cut downward trend line guiding the pair. So that by itself should be enough for us to adopt a bearish outlook. The price action also has breached the S1 1.3410 and now turned to resistance. The second element I would be highlighting supporting a bearish outlook would be the RSI indicator. Note how the indicator has been dropping. And practically is nearing the reading of 30, implying a rather strong bearish sentiment on behalf of the market, which could drive USD CAD even lower. The third element would be the switch of the inclination of the 20 moving average, which is the median, the blue line here in the middle, the median of the Bollinger Bands. Note how it has turned southwards, while similar tendencies seem to be adopted also by the 100 moving average. I think that would become even clearer should we switch the 100 into a 50 and the 200 into 100. Here, yeah. So you can see how the 50 moving average has started to fall and it's nearing, it's about to bearishly cross over the 100 moving average, while the 20 moving average is already doing it. So we have a small signal here that the bearish outlook is in place, and that would be the third element supporting a bearish outlook for the pair. Now, given that the downward motion is being maintained, the big question arises, how low can it get? And in that case, I would be noting that we had a number of shows here, but I would be highlighting this one. It was a very, very interesting show. It had provided support a couple of times, and in my opinion, that's the next possible target for USD CAD. So I would be highlighting the possibility of USD CAD actually maintaining a downward motion with the next test point on a technical level being set at the 1.3320. We're talking about 90 pips lower. Now, should the 1.3320 also be broken, next possible target for the bears, I would be setting it at 1.3180. I know there have been lots and lots of analysts which have been mentioning a possible mid-level between our S1 and S2. I'm going all the way, and I'm actually highlighting these shows here. It was a very interesting point at which the downward motion, you can see, has been reversed, and it held its ground. So that's a pretty valid level in my opinion. I'm keeping the 1.3180 as the next possible target for the bears after the S1. On the flip side, should the pair stabilize, I would expect it to breach the R1 1.3410, breach also the pre-mentioned downward trend line in a signal, a first signal that the downward motion has been interrupted, and remain between the R1 and the R2. On the flip side, should the bulls take over, which is a remote scenario for the time being, but it's worth mentioning, especially should the USD side of the pair start strengthening substantially, then we may see the pair rising, breaching the R1, 1.3410, breaching the downward trend line as we have mentioned before. Yet I would require also a breach of the R2, 1.3540. I would like to see the price action of USD CAD escaping these peaks here before adopting a bullish outlook for the pair. Let's have a look at AUD USD. Now, AUD USD, in my opinion, has maintained a sideways motion. And I think that's pretty clear in the sense that you can see there how the pair has hit the ceiling at the 0.6620. It's a pretty narrow sideways motion. We're setting it between the R1 and the S1. The S1, I know it's lower than the lowest points in the past, I would say 1 week, but it was a very interesting support level in the sense that it was the one which halted the downward motion of the pair around the 17th to 18th of January. So that should be more or less be validated should the pair start dropping once again, or at least it would be an interesting focal point. For the time being, once again, we tend to maintain a bias for the sideways motion. Note how the R1 0.6620 has provided resistance once, twice, yet the pair continues to have higher throws, which more or less tend to imply some bullish tendencies. The RSI indicator, on the other hand, though, despite at some point breaching above the reading of 50, it has now corrected lower, and it's nearing the mid level once again, implying a rather indecisive market, which could allow the sideways motion to be maintained. Also note how the Bollinger Bands, 1, 2, have narrowed, and they're reflecting actually the lower volatility characterizing the pair. Now, on a fundamental level, we have two issues to keep an eye out for as Aussie traders. The first would be the release of Australia's CPI rates for Q4 that's due out tomorrow during the Asian session. Is expected to slow down, and in that case, we may see the Aussie weakening as the easing of inflationary pressures in the last quarter of the past year would be verified, and that could be exercising pressure on RBA to start cutting rates a little bit earlier. Other than that, I would also be noting the Chinese NBS manufacturing PMI figure. It's for January, it's due out tomorrow in the Asian session. It's expected to drop slightly, but it's not the drop, to rise slightly, but it's not the rise as such which is the interesting element in my opinion. Now, the figure of the Chinese manufacturing sector, the PMI figure of the Chinese manufacturing sector, is expected to rise from 49 to 49.2. Now, the rise as such, theoretically, it's a positive as the indicator improves, but the figure remains below the cutoff point of 50. And that tends to highlight more or less another contraction of economic activity in the critical Chinese manufacturing sector. I wouldn't say that the sector is going down the drain, but the indicator tends to highlight the struggle of Chinese factories to actually maintain economic activity. And that's an issue which once again underscores the problems which China has in its efforts to actually start revitalizing its economy. And that could weigh on the Aussie. Other than that, on a deeper fundamental level, we're highlighting also AUD's nature as a commodity currency. And that tends to provide a perception in the market that it's a riskier asset. So the Aussie, actually like the CAD, but the Aussie is more sensitive to the market sentiment, say, for example, whether it's cautious or optimistic, if compared to, say, the euro or the pound. So should the market sentiment actually turn sour, we may see the Aussie weakening as the prospects of the global economy advancing will be dimming. In such a case, we may see once again fundamentally bearish tendencies being built up for AUD/USD. Okay, let's have a look at WTI oil. Okay, the labels are out of date. Definitely we need a recovery here. We need a clear recalibration of the levels. Let's start with the R3 and go onwards. Now the R3 is pretty valid. Should there be an R4, I would be placing it on this peak here. But for the time being, we can see how this peak has hit a ceiling at the 85.45 resistance line. I would be also noting as the R2 the 82 resistance line, and I'm basing it on this peak, but also on this true. Yeah, it has also provided resistance here, so that's pretty valid. The R1 is being placed on this peak here. The S1 now is practically a former resistance line. You can see how it was tested once, twice, but given that the price action has moved above it, its role has been reversed and it's now being set as a support line. One could argue here that practically the level could narrow given the peak here. That's a pretty valid level. So we could be setting it, say, for example, somewhere here. On the other hand, though, once again, this point here has more touches. 1, 2, 3, and as a support 4. So in my opinion, that's more valid. I'm skipping this one. Then we have a support line somewhere here. You can see it once, twice. One could narrow it a little bit. Widen it. Okay. And moving backwards, let's see the validity of the S3. Nice touches here. Could be a little bit higher. At 67. Locking it in, readjusting the chart. Okay, let's make this chart beautiful once again. The R3 being placed at 85.45. The R2 at the round figure of 82. The R1 is being placed at 79.15. The S1 at 75.25. The S2 at 70.25. And finally, the S3 being set at 67. Okay, let's talk direction. We have a very, very interesting element here. And it's practically this. See how the price action is about to test if it hasn't breached already. The upward trend line guiding the commodity's price since around the 17th of January. Should the upward trend line be clearly broken, I would expect the price action to maintain its sideways motion, and I would be setting as the upper boundary, this peak here would be actually the R179.15, while as a low boundary, I would be setting the 75.25 support line. Yet at this point, I would be also noting that the 100 moving average has bullishly crossed over the 200 moving average. Yet I would be noting here that most probably that's a delayed picture and the moving averages have not yet picked up on the stabilization of the commodities price action. I think that a more related picture would be set if we moved the 100 moving average to the 50 and convert the 200 to a 100. And that shows us with more exact picture that when the price action started to rise, you can see the bullish crossover right here. It was a little bit delayed, but yes, it was far, far nearer. And it's interesting that at this point we have a triple crossover between the 20, 50, and 100 moving averages. Okay, so for the time being, we tend to maintain our bias for the sideways motion to continue. And that's being also implied by the lowering of the RSI indicator, which has neared the reading of 50. It's still above it. It's actually at 56, yet it's pretty near and stable. While the Bollinger Bands have narrowed, you can see how they're closing in, implying low volatility for the commodities price. Okay, let's have a look also at US stock markets. And given that we have a number of mega cap high-tech companies releasing the earnings reports, I'm going directly to US 100. Ladies and gents, this is this is NASDAQ. Sorry. So we tend to maintain here clearly a bias. This is the daily chart, by the way. And allow me to drill into the 1 hour chart. Nah. I think we get a clearer picture with the daily chart here of the upward motion of the index's price action, which is currently aiming for the 18,000 S1. The RSI indicator is above the reading of 70, implying a very strong bullish sentiment on behalf of the market for the index. Allow me to have some doubts in the sense that the RSI indicator is above the reading of 70. That may also imply that the index has reached overbought levels and may be ripe for a correction lower. Yet, once again, for the time being, we tend to maintain a bullish outlook, and we maintain that as long as the upward trend line remains intact. At this point, it would be interesting to see also how Bollinger Bands would be behaving. And from the indicators, trend, Bollinger Bands, a 20 moving average in dark blue, it's widening, ladies and gentlemen. Note how the Bollinger Bands, the lower one and the upper one, are widening the distance between them. Also, let's have a second look at the moving average, and let's convert the 100 moving average into a 51 to get closer to the price action. And the 200 moving average into a 100 one. A clear upward slope, which is formed by A, the upward trend line, B, the 20 moving average, C, the 50 moving average, and D, the 100 moving average. Everything points upward. Once again, a small warning here that a correction lower is possible. This could be within the cards given that the RSI indicator has surpassed the reading of 70. Okay. Let's have a look also at gold. Yeah, that's interesting. What's so interesting about gold's price? What's interesting is the fact that the price action of gold seems to have been building some bullish tendencies, which would be clearer in the 1 hour chart. Widening it, you can see how there is an upward movement. Right here. It's a very slight, steady upward movement. It's characteristic how the precious metals price has surpassed the 120, 135. Now, on a fundamental level, before we move to fundamentals, I would be actually raising the R1 a little bit higher, so we have an exact touch once, two, come on. Here it is. You have touches here, 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 and here. And that would be 1.2038. Now, fundamentally, gold is going to be a very, very interesting trading instrument over the next few days. And I'm highlighting it because fundamentally, we have a number of factors which could affect its price action or the direction of its price action, to be more exact. And we make a start with the Fed's interest rate decision. Now, given the negative correlation of the US dollar to gold, or at least the perceived negative correlation of the two trading instruments, should the Fed actually sound more hawkish and provide more support for the USD, that may weigh on gold's price and vice versa. On the flip side, on Friday, we are getting the employment report for January of the US, and the prognosis is not so good. Okay, the US employment market remains tight, but there seems to be a crack building up within the employment market. On the other hand, we have to note here that forecasts have been broken a number of times regarding the NFP figure. And it was most characteristic of the December report, where the actual NFP figure rose above 200, actually above 230. So should there be support for the USD from the US employment report for January, I would expect gold's price to start weakening and vice versa. The last element I would be highlighting here, although a little bit far-fetched, would be on a deeper fundamental level. We may see safe haven inflows for gold's price, as practically tensions in the Middle East seem to be escalating. Now, they haven't escalated that much yet, but in our opinion, the fact that there was a direct hit on US troops in a post in Syria, that was 3 days ago, that tends to be a game changer for the Middle East conflict, and we're quite worried. Should there be further escalation in the Middle East, we may see safe haven flows supporting gold's price and pushing it substantially higher. More or less, that should be it from all of us here at IronFX. Best wishes for solid trading.
Everyone, the term risk-off refers to the mood of traders and investors in the financial market when they want to avoid risk exposure and safeguard their funds. When traders are pessimistic about the economic outlook, they tend to sell risky assets and buy safe haven assets. In such an environment, safe haven assets like the Japanese yen and gold tend to gain in value, while high-risk assets like stocks and commodities tend to decline. Markets are frequently labeled as risk-on or risk-off. Both of them express global market sentiment. Risk-on, risk-off is frequently abbreviated as RORO. This happens when price behavior is driven by investors and traders' changes in their risk tolerance. When traders are not optimistic, then they tend to reduce leverage, selling risky assets and buying safer assets or even preferring cash. US Treasuries and German bonds are considered almost risk-free. The US dollar, Japanese yen, and the Swiss franc are safe havens and tend to rally when traders want safety during times of uncertainty. The price of gold usually increases and the yield on government bonds falls. Thank you so much for watching us today, guys. Stay tuned. Bye-bye.
Right. Okay. Before we kick things off, let's quickly go through the risk warning and disclaimer as well. Do take note that all the products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. Right. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. All right. Do take note of the disclaimer as well. The information in this webinar should not be considered investment advice or investment recommendation, but instead educational material only. All right, so my name is Ketan Ramachandra. I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, so today's webinar series will be the first part of the Fibonacci series. So we'll be looking at retracements. So we'll start off with the basics. Of course, we'll look at how do we identify an ideal market structure? How is it different from something that's non-ideal? Why is that important? Because when we are trying to use the Fibonacci retracement tool, we should be looking for ideal market structure or something that resembles as closely as possible to an ideal market, right? Being the real life world, nothing's ever ideal when it comes to market structure or price action, but we are going to look for something that's going to be as close as possible to the ideal structure. Then we will look at how we can follow the market structure so as to achieve good or to achieve significant Fibonacci retracement levels, right? When we do not use the Fibonacci retracement tool correctly, and when we do not follow the market structure as closely as possible, then the retracement levels that are highlighted by the Fibonacci retracement tool will not indicate significant resistance or support levels, right? So that's the basics. We are going to identify what is an ideal market structure, what type of price structure in reality mimics the ideal market structure, and then how to follow that, and how do we draw the Fibonacci retracement from the starting point to the end point. Then we'll also look at the various Fibonacci retracement levels. Then we'll also touch on the negative Fibonacci levels as well as the levels that are greater than 100%. All right, so if you have any questions along the way, do not hesitate to drop your questions in the Q&A box or the chat box. I'll be more than happy to go through your questions should there be any doubts along the way. All right, so let's start off with the ideal market structure. What is an ideal market structure? Well, first of all, we'll start off by looking at what is wrong, right? Okay, so when we are trying to draw a Fibonacci retracement, we're looking for significant swings, right? So we're looking for market swings, so like a swing high or a swing low, right? In this example here, what we are seeing, this GIF is showing us an example of insignificant swings, right? So you can see here, I'll just label it, this is number 1, this is number 2, right? So swings like these are pretty insignificant, right? And also here, looking at here, 3, this is a swing high, 4 and 5, right? When you look at 1, 2, or even this one here, let's label this 6. You can see this swings, all these swing highs here, these are the highs, they're all pretty insignificant. So we're not looking for these sort of insignificant swing highs, right? Similarly, when we look for the swing lows, you look here, A, B, C, D, right? These are insignificant swing lows, right? So we're not looking for this type of market structure where the swing highs and swing lows are insignificant. This is pretty noisy, right? To a certain extent. So what we're looking for in a market structure that will have significant swings. Now, this can be swing highs and swing lows, of course, right? So now that we've had an example of what is or what are insignificant swings, let's move on and try and see how do significant swings actually look like, right? Okay, now here we have a GIF showing us examples of how to identify significant swing highs and significant swing lows, right? As you can see here, we need to look for significant swing highs and lows. So clearly we can see here, point number 1 is a significant swing high. Point number 2 here is a significant swing low. Point 3 is another significant swing high. Point 4 is another significant swing low. Point 5 is a high. 6 is a low. 7 is another high, right? So this GIF is clearly illustrating how do we identify significant swing highs and lows in market structure, right? So you can clearly see this is a swing high here, point 1. This is a low, high. Number 4 is a low, 5 is a high again. 6 is another low, and 7 is a high, right? So do take note. This is how, this is a type of market structure that we're typically looking for when we're trying to identify swing highs and swing lows, because that's very important. That's basically the main foundation of Fibonacci retracements. We need to identify the significant swing highs and swing lows so that when we actually use the retracement tool and we draw the Fibonacci retracements, we are going to get retracement levels that would actually function as, or that would potentially function as very significant resistance or support levels, right? So what we're trying to do is increase the probability of these retracement levels functioning as a significant support or resistance, right? If you don't draw the Fibonacci retracement in the correct manner, the subsequent retracement levels are very likely not to yield any significance, right? Be it as a support or resistance, okay? Right, now how do we follow the market structure, right? Now that we've identified significant swings, highs and lows, now how do we identify, how do we follow the market structure when we use the Fibonacci retracement tool? So as we can see in this GIF here, point 1 is clearly a significant swing low. That's fine, that's great. 0.2 is also a significant swing high. 0.3 is another significant swing low. And 0.4 is another significant swing high. But in this example, they're drawing the Fibonacci retracement starting from 0.1, but going all the way up to 0.4. As you can see here, the highlighted diagonal line, right? You can see the highlighted diagonal line is going to come up again. Now that highlighted diagonal line in blue, that is the trend line of the Fibonacci retracement tool, right? Fibonacci retracement tool. So when we start Fibonacci retracement, we always start from the left to the right. So when we're doing it for the upward part of the move, we're always going from bottom left to top right. Similarly, when we draw the Fibonacci retracement for the downward move, we're going to go from top left to bottom right. So do take note, this is another key aspect of how to use the Fibonacci retracement tool. We always go from left to right. So if it's an uptrend, if market structure is going up, right, we always go from 0.1 on the bottom left to 0.2 on the top right. Similarly, when we have a market structure that's showing a strong downturn, we're going to go from 0.3 to 0.4. That means we're going to go from top left to bottom right. Remember, Fibonacci is always left to right. Yeah. Whenever we are drawing the Fibonacci retracement tool, be it for the upward move or the downward move, we always go from left to right. So for the upward move, for the uptrend, we're going to go from bottom left to top right. And for the downtrend, we're going to go from top left to bottom right. Okay, that's another key aspect of using the Fibonacci retracement tool. All right, now going back to that trend line, remember I was talking about that can you see here, this highlighted in blue, this trend line. Now in this example, they've started this Fibonacci retracement starting from 0.1 and ending it at 0.4. We can clearly see that the trend line is not capturing the market structure at all, right? We can see that there's plenty of gaps to the top of the trend line as well as to the bottom of the trend line. So in this type of market structure, the ideal Fibonacci retracement, right, to be drawn would be from 0.1 to 0.2. So when we draw it from 0.1 to 0.2, we can see that the trend line will capture the market structure much better than from 0.1 to 0.4. Similarly, when we're doing it for the downtrend, we'll start from 0.2 to 0.3. And when we do that, the trend line will capture the market structure very closely. So that's what we're looking for. We're looking for the trend line to capture the market structure as closely as possible, be it to the upside or to the downside. So that's how we know whether we've drawn the Fibonacci retracement using this correct starting and ending points. Do take note, if the trend line does not capture the market structure very well, that means it's quite likely we have not used the ideal starting and end points for the Fibonacci retracement, right? Okay, let's go on to the next slide. Now here, we can see we've identified 0.1 and 0.2. 0.1 is the starting point, 0.2 is ending point, and you can clearly see that the blue trend line has captured the market structure as closely as possible. Of course, there are going to be a little bit of gaps to the downside and to the up of the trend line, but in general, we can see that this trend line has captured the market structure very well. Now, similarly, if we had drawn the Fibonacci retracement from 0.0 to 0.1 here, right, we would have seen that the trend line would have captured this market structure very well as well, right? Would have captured this market structure pretty well, right? So this is what we are trying to emphasize and highlight. So be it for an uptrend or a downtrend, Fibonacci retracements, we always go from left to right. For the uptrend, so bottom left to top right. And for the downtrend, we start the retracement from the top left, and we end at the bottom right. Right, and the other aspect to take note of, or the important point to take note of, is the trend line must capture the market structure as closely as possible, be it to the downside or to the upside. All right, great. Okay, let's move on to the next slide. All right, so now that we've had a quick look of how to identify ideal market structure, how to identify significant swing highs and swing lows, And also we've also seen how to draw the Fibonacci retracement in a manner that is going to give us significant retracement levels, right? We saw we have to start, we have to identify significant swing lows here. You can see 0.0 is a significant swing low, 0.1 is a significant swing high, and 0.2 is another significant swing low. And similarly, when we choose the most ideal starting and end points, the blue trend line is very likely going to capture the market structure very closely, right? So do take note of that. All right, okay, with that, now we're going to look at the various Fibonacci retracement levels. Okay, for those of you who may be aware or have used the Fibonacci retracement tool before, so we know that this goes from 0 to 100, right? 0 to 100%. Right, so the retracement levels as highlighted here, as you can see, or well, not highlighted, but as described in this image, you can see that the retracement levels run from 0% to 100%, right? So the key retracement levels are at 23%, 38.2%, 50%, the golden ratio of 61.8%, and the 78.6%. So there's 1, 2, 3, 4, 5 key retracement levels, right? So when we talk about the Fibonacci retracement levels, we're talking about the 5 key retracement levels running from 0 to 100, and they are, right, 23%, 23.6% to be precise, right? 38.2%, 50%, 61.8, which is the golden ratio, of course, and we end up with 78.6%, right? So do take note, these are the 5 key retracement levels: 1, 2, 3, 4, 5. 23.6%, 38.2%, 50%, the golden ratio 61.8%, and of course the 78.6%. Now, in this example, we have started this retracement from 0.1, the starting point 0.1, right? And the ending point 0.2. So do take note, Fibonacci retrace, the starting point of the Fibonacci retracement will always indicate 100%, and the ending point will indicate 0%. So conversely, if I were to draw the Fibonacci retracement from this part here, let's just identify this swing low as 0.4. Now, let me just tidy this up a little bit. Right, let's just identify this swing low as 0.3 and this swing high as 0.4. So when I draw the Fibonacci retracement starting from 0.3 to 0.4, my starting point is going to show me 100%, and the ending point is going to show me 0%, right? Just like how we see here on this downtrend, right? On the downtrend, we start from top left and we end at bottom right. Conversely, for the uptrend, we start at bottom left and we end at the top right. So starting point is always 100% and ending point is 0%, right? And the key retracement levels, like I said, are the 5 key retracement levels at 23.6%, 38.2%, 50%, 61.8%, and 78.6%. Now, in this example, we're also showing Fibonacci levels that are greater than 100% and lower than 0%, right? So the negative retracement levels are the key retracement levels at the negative point are negative 27.2 and negative 61.8%. We'll touch on this a little later. Similarly, extension levels that are greater, Fibonacci levels that are greater than 100%, the key levels are at 127.2% as seen here, and what is not seen is at 161.8. But for now, let's just focus on the retracements, right? So 23 to 78.6, right? So as I mentioned, we started at 0.1. We started this retracement, right? We started this retracement at 0.1, 100%, and we end at 0.2, which is 0%, right? So we can only start this once the price has formed the swing low. So basically, we're waiting for price to make this significant swing low here, come up here, maybe the first after the first 1 or 2 candles or 3 candles, depending on your time frame. Let's just assume we are on the 4-hour time frame and we see 2-3 candles, at least 1 or 2 candles being formed after we see the significant swing low, that's when we can draw the retracement. So in this case, we're drawing the retracement from point 1 to point 2. And what the subsequent retracement levels at 23, 38, 50, 61, and 78.6, what these levels are going to highlight. These levels are what these levels are going to highlight are potential resistance levels. Do take note when we draw the Fibonacci retracement for a downtrend like this, the subsequent retracement levels are going to help us identify potential resistance levels. All right. Conversely, when we draw the Fibonacci retracement for the uptrend, right, we're going to start from 100% and at 0. What the subsequent retracement levels tells us is going to highlight to us is our potential support levels, right? So we got 23.6%, 38.2%, 50%. So for the uptrend, the retracement levels are going to highlight potential support levels. And for the downtrend, the retracement levels are going to highlight potential resistance levels. Okay. Right. So as you can see here in this example, 23.6% didn't offer much resistance, right? You could see price just stalling briefly here before going higher, where it does seem to have run into resistance. Okay, then after that 38.2%, we can clearly see price breaking above 38.2% as well, where price failed to break above is at the 50% retracement, right? Clearly, we can see here price has failed to break above the 50% retracement. So this is a major resistance for price for this current example. So we can see just because we have a retracement level at 23.6% and 38.2% does not mean that price is going to stall at this level and reverse and drop lower, right? They are just points that are going to help us identify potential, right? What is important here, they are highlighting potential resistance levels. It doesn't mean that they will act as significant resistance levels, but what the retracement levels here are going to highlight is they are highlighting potential resistance levels. So, but in this example, you can clearly see 23.6% and 38.2% did not offer any major significant resistance, where price did stall was under the 50%. So now we know for that 50% is a significant resistance level and is going to take something pretty like a strong catalyst for price to break above this level. All right, so do take note, the retracement levels highlight potential support or resistance. They do not indicate or they do not guarantee that these retracement levels are going to function as very significant support or resistances, right? Do take note. That's a very important, another important aspect of using the Fibonacci retracement tool. All right, okay. Moving on. All right. As I mentioned, the key retracement levels are 23, 38, 50, 61, and 78. Levels that are lower than 0. We also have Fibonacci levels that are lower than 0%. And we have Fibonacci levels that are higher than 100%. So we're going to get to those as well. All right, so the negative Fibonacci levels, right? So the negative Fibonacci levels are also known as expansion levels. You can see the key negative Fibonacci levels are negative 27% and negative 61.8%, right? These negative levels are also known as expansion levels, all right? So you may hear or come across this term, so do not be confused if you come across the term Fibonacci expansion or expansion levels, right? They simply refer to the negative retracement of negative levels, which are at negative 27.2 and negative 61.8. All right. Okay. So these are the key retracement levels for the negative at the negative end, and they are also known as expansion levels. Now, how can we use this? Okay. How can we use these expansion levels? Well, first, right, you can see we started this retracement from point 1 here, and we ended at point 2, right? And we can also see 50% is here. So in order to use the negative levels, or not rather to use, but for the negative levels to provide or to function as significant support levels, we actually need to see price retrace up to at least 50 to 61.8%, right? Do take note, price must retrace right? After forming this low here, this significant swing low here, price must retrace to at least 50% or even better 61.8%, so that when we see a market structure like this, and then should price reverse and drop lower, breaking under the 0% or the ending point, that means that these negative levels are expansion levels at negative 27.2 and negative 61.8% Fibonacci are going to potentially function as significant support levels, right? So do take note, this is another key aspect when using the expansion levels. The Fibonacci, the market structure must retrace up to 50 to 61.8%. It must, right? So at least 50%, and then should price reverse and drop lower, breaking under the ending point. That means negative 27.2 and negative 61.8 are going to potentially function as significant support levels. Okay, this is a very important aspect, because if price only retraces up to 38.2% and then stalls and reverses to drop lower, that means this levels here at negative 27, negative 61 may not offer significant support, right? Do take note, this is one key criteria, right? The key criteria is the retracement has to come up to at least 50%, right? The retracement has to come up to at least 50%. I'm talking about this retracement here, right? It has to retrace up to at least 50%, even better if it comes all the way up to 61.8. And then as it reverses to drop lower, the expansion levels are then likely to function as significant support. All right. Okay. Now, in this example, we can see clearly that price has retraced to 50 and has even reached 61.8%, right? And then has now started to reverse and drop lower. Now, so how can we use these expansion levels? First off, as price starts to retrace to drop lower, we can also use the 0%, for example, as a potential take profit level, right? So if you go short on this position here and price is reversing, right? Perhaps there's a strong bearish catalyst that has a combination of a strong bearish catalyst, and your technical analysis is telling you this is now a potential short entry, where you would identify your take profit would be potentially here at the major swing low here at 0%. And should price continue to break lower, you can identify your second TP or take profit at the negative 27.2%. So, right, this is where we can this is how we can use the negative Fibonacci levels or the expansion levels to help us identify potential take profit levels for the short side, right? So in this example, you're seeing it for the short side, for a potential short trade, right? So typically, in this scenario, price will, if price breaks below this swing low here, it will typically find support at negative 27.2%. And usually it does bounce off this level to return to 0%. So do take note. So this is how we can use the negative 27.2% Fibonacci expansion level to help us identify a potential take profit on the short side, or for the potential short trade, right? Okay. With that, okay, now we're going to look at Fibonacci levels that are greater than 100%, right? The key Fibonacci levels that are greater than that are greater than 100%, as I mentioned earlier, at 161.8 and also at 127.2%, right? These are the two key significant retracement levels. Levels that are greater than 100, and these levels that are greater than 100, they're also known as Fibonacci extensions. All right, do take note. Right, so if you come across the term Fibonacci extension levels, it is simply referring to levels that are greater than 100%, and they're specifically referring to 127.2% and 161.8%, right? Just like for the Fibonacci expansion levels, so similarly, if you come across the term Fibonacci expansion levels, they're referring to levels that are the negative levels, and specifically referring to negative 27.2 and negative 61.8. Okay, so expansion levels are negative, also known as the negative Fibonacci levels, also known as Fibonacci expansion levels, and the Fibonacci levels that are greater than 100% are also known as the extension levels. And the key extension levels come in at 127.2 and 161.8%. All right, so in this example here, right, we see price from this starting point here, point 1 making the swing high here, and then point 2 has made the swing low here. So how we can use the extension levels is we can use these extension levels to help us identify the take profit, a potential take profit zones. Sorry. So in this case, you can see price has made this Nike tick structure. You can see this Nike tick structure, right? We all know the company Nike and its logo, which is the tick. And you can also clearly see a price. This market structure here is following this Nike tick structure. So what we see is, or how we can use the extension levels is when we see price reverse strongly and come back up to the starting point, which is at 100%. Here we can say we're looking for potential bullish breakout here, right? We have our technical indicators telling us that this is a strong bullish move. We also have a strong fundamental data catalyst that's driving this move as well. So we are looking for potential bullish breakout. So when price breaks above 100% here, how we can use the extension levels is we can use them to identify potential take profit. So for example, 161 here has been identified here, and 127 is probably somewhere around here. So we can use these extension levels to identify potential take profit. So this could be the second take profit zone, whereas the 127.2% would be the first take profit zone, right? So this is how we can use the extension levels to help us identify potential take profit zones should price break above the 100% or the starting point and continue to drive higher. And then from here is where you could potentially is to identify a major resistance level. And from here, you could also potentially initiate a short trade idea as well. Because when you see price failing to break above the 161.8% extension level, it is quite likely it is going to drop lower. So as price moves away from this extension level and starts to drop lower, you can initiate a short entry, and your stop loss will be placed slightly above the 161.8% Fibonacci retracement to give us a little bit of a buffer, right? To give us a little buffer. So should price retrace back to the 161% as you can see here, but because we've kept our stop loss slightly above the extension level at 161%, it allows us to remain in the trade. And should price continue to drop lower, we can benefit from this potential short trade idea as well. So you can see how the extension levels can be used to identify potential take profit zones to the upside. And then once it hits 161.8% Fibonacci retracement extension, and then it starts to pull away, you can also consider initiating a short trade idea where you put the stop loss slightly above the 161.8% Fibonacci extension. All right. Okay, great. Let's see. All right, okay. We've come to the end in terms of my slides. So what are we going to do? What we are going to do now is we are going to move over to TradingView and try and find examples of how to use the Fibonacci retracement tool correctly, right? So we're going to start, of course, just start off with the basics. All right. Okay. So here I am on TradingView. I'm on the 4-hour time frame, and I'm going to use the dollar index as an example, right? So first of all, we're going to try and identify significant swing highs and swing lows. So let's just do this exercise together, right? So just to take note, when we are using Fibonacci retracement tools, they generally work better on the higher time frames, right? So they generally work better on the 1-hour time frame and above, right? You can use them on the lower time frames as well, 30 minutes, 15 minutes, but they may not offer the same level of support or resistances as when we use them on the higher time frames. So do take note about this aspect of using Fibonacci retracements, right? They do tend to work better on the higher time frames, such as 1 hour and above. All right. Okay, so first of all, we do a simple exercise. on trying to identify significant swings, right? As we saw in the slides earlier, right? We saw examples of insignificant swings, and now we're going to look at examples of significant swings. So this is I'm on a 4-hour time frame for the dollar index, DXY. My chart is showing the price structure from end of September all the way to present time. So I think it's quite clear by now where the significant swing lows and swing highs, right? So, right, you can see here this is a significant swing low here. Okay, maybe hang on. Right, let's start off with swing highs. We can see this is a significant swing high. This is also another significant swing high here. This is another significant swing high. This is another high. This as well. This as well here, right? So 1, 2, 3, 4, 5, 6, right? These are generally how we would identify significant swing highs, as this one here as well. So the red circles are, I'm highlighting the significant swing highs in red. And now I'm going to highlight the significant swing lows in green. So you can see here, this is a significant swing low. This is another swing low here as well. Here, 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 and of course here, right? So what we're actually trying to look for, right, is I'm going to now just use a different color. So we're going to look for significant swings, right? So you can see when price makes a very strong V-shaped move here like this, as highlighted in the orange line, right? You can see that this is a very significant V-shaped move, right? And this tells us this is a significant swing low, and this is a significant move. Similarly, right, when I draw the swing high from here, we can see this is an inverted V shape, right? We can see a very clear significant swing high with a strong inverted V shape as well. Similarly, for this downside, we see a strong V shape here. And then for this swing high here, we can see generally the pattern I'm trying to get at. You can see that this is another inverted V. Similarly here, this is a strong V shape pattern here, swing, another strong inverted V shape here, another strong inverted V shape here, strong V shape pattern here to signify the significant swing low, another one here, inverted V shape to indicate the swing high, another strong V shape pattern here to indicate the swing low, and this high here, low here, high here as well. This is also a pretty significant swing low bounce here. And of course, this significant swing low over here. Right, so you can clearly see how we can identify major swing highs and swing lows, right? That's important, right? So as you can see here, I'm just going to leave this on for a bit before I erase it. So you can clearly see the green circles highlighting the significant swing lows, whereas the red circles are highlighting the significant swing highs. And you can see by my orange V shapes as well. We see an inverted V shape as well as the regular V shape that show us the size of the move, right? We're looking for significant swings and lows and highs, and the size of the move can be is highlighted by my orange brushes, right? You can see that the moves are very significant. So this is how we identify swing highs and swing lows, so that we are able to identify ideal starting and ending points for the Fibonacci retracement, right? Okay, so now I'm going to clear all of this, and I'm going to show you how we can draw the Fibonacci retracement for on these swing highs and swing lows. All right, so we'll start with here on 29th of September and we'll end here on 3rd of October. Okay, so for those who may not be familiar with the Fibonacci retracement tool, the icon looks something like this, right? So you'll see 4 lines and you'll have the bubble here as well, the circle here on the left and on the right. So if you highlight it, it'll show you depending on whatever platform you're using, but if you're using a trading view, right? If you highlight over this icon here, it'll tell you Fibonacci retracement. So that's what you want to use. So we click on that, and we're going to start with the absolute low point here. Okay. So I'm just going to zoom in a little bit. Right. So I'm going to just zoom in a little bit. This is my starting point, right? So remember, for this is an uptrend, so Fibonacci retracement always goes from left to right. Since this is an uptrend, we're going to start from the bottom left and we'll end at the top right. Okay, I'm going to pull up all the Fibonacci levels here. So this gives me the negative levels, the positive levels. Remember, negative levels are called expansion levels, and levels greater than 100 are called extension levels. Okay, right. Okay, but with that, I'm just going to focus on the retracement levels in this example, right? So as not to overcomplicate things. So I'm going to get rid of the extension levels as well as the expansion levels, right? And we're just going to deal with the retracement levels going from 0 to 100%, right? So then this is much more clear. So when we draw the Fibonacci retracement from this uptrend here, bottom left to top right, and as price is coming down, these retracement levels are going to potentially are going to highlight potential support levels, right? Now, whether these levels truly function as significant support levels, we can only tell when the move plays out. But generally, it does help us to identify potential support areas. So as price has made this swing high here and started to come down, we can see that price did find decent support at a 23.6%, retracing higher before falling lower. Then again, you can see here, it did find a little briefly found support here at 38.2%, again at 50, then also pretty strong support here, 61.8%, 78, and then finally 100 down here, right? So you can see clearly in this example here, price did seem to find support at almost nearly every single retracement level. Now, this doesn't always happen to be the case, right? There, as we saw in the slides, right, there can be cases where price will just simply break through the 23, 38, maybe even the 50, and then find support at the 61.8%. So do take note, in this example here, we do see price to have clearly found support at each of the retracement levels, right? Okay, this was an example for the uptrend. Now I'm going to draw a Fibonacci retracement for the downtrend, right? So this was the uptrend, bottom left to top right. We can clearly see here, this is a strong move down. We have a nice significant swing high here on 3rd of October, and we have a significant swing low here on the 12th of October, right? So we're going to start this retracement from here. Remember, whether it's a uptrend or downtrend, we always go from left to right. So since this is a downtrend, we'll start from, we'll start from the top left and we'll end down here on the bottom right. So in this example, we can clearly see price has broken through 23, 38, and 50% very easily, right? Very easily. These retracement levels here did not offer a hint of resistance at all. Where it did finally run into resistance was at 61.8%, right? And then after that, over the next half a day or so, price briefly broke above the 61.8 as well before dropping lower. So you can see where price found major resistance in this example is at the 61.8%. Do remember over here when we did the Fibonacci retracement on this uptrend here, we could see price finding support at every single retracement level. However, for this part of the move, we can see where the only level that offered serious resistance was at the 61.8% Fibonacci, right? So you can clearly see no two Fibonacci retracement is going to behave the same way, right? We are never going to see the same retracement levels functioning as a major support or resistance, right? Every swing high and swing low, or every uptrend and downtrend is going to be different, right? So do take note of that. There's nothing set in stone with regards to the Fibonacci retracement levels. It could be a case where the retracement levels offer support or resistance at every single level, or there could be a case like what we're currently seeing, where only the 61.8% has offered significant resistance. All right. Okay. So here we can see the price running into resistance 61.8 on 12th of October, 13th of October, as well as 19th of October, right? Okay, so these were the two examples of how we can use how we can draw the Fibonacci retracement for an uptrend and downtrend. All right. Okay. Now let's move over to somewhere to where price is currently trading, right? Let's see where price is currently trading and perform some technical analysis here using the Fibonacci retracements. All right, okay. So once again, before we try and draw the retracements, let's do a simple exercise where we can try and identify the significant swings, right? Okay, so this is a green. All right. So we can see here, this is a pretty significant swing low here on 29th of November. Another significant swing low here on 15th of December. This significant swing low here on 28th of December. So when we look at end November till now, we can see 3 significant swing lows when we're on the 4-hour time frame. All right. Okay, now I'm going to try and identify significant swing highs. Right. You can see here, this portion here is a pretty significant swing high here. And over here, okay, price has not yet played out, but you can generally see the top of this wick is another significant swing high as well. Right. Okay, so let's just say, okay, let me just okay, I'm just gonna highlight my points so it's easy to refer to as well. All right, so let's work with points 1, 2, and 3 first. All right, let's work with the first 3 points. All right, so we have identified our major swing highs and swing lows. So let's just focus on the first 3 points. So for this upward trend here, we would be actually technically we would have highlighted this as 0.2 because as price was pulling down, we have highlighted this as 0.2. So we'll take this in step by step. So we'll start the retracement for this uptrend here from 0.1 to 0.2, right? You can see here in this example, as price was pulling back, 23.6% did not offer any support at all. 38.2 not really, because we can see the wick extending way beyond the 38.2 and even dipping below the 50%. So where it did find support here in this example was around the 50% Fibonacci retracement, right? As we can see here, the body of the candles actually closing underneath the 38.2%. And we can also clearly see the wick extending beyond the 50. So where price did find support in this example was at 50% before going higher. And as price comes up here, right, when a new high is made, we cannot use 0.2, the original 0.2 anymore. If we do wish to use the Fibonacci retracement, we have to move our ending point now because this is a new high. We have to move it to here, which is, yeah. And in this sense, you can see the trend line, right, is capturing the market structure quite well, right? It's not as ideal, as perfect as what we saw here at the first go. You can clearly see the trend line has captured the market structure very well. But even when it makes this second high here, you can see that the trend line has captured the market structure quite well. So we can still use this. So similarly here, 23.6% did not offer any support. Where it did find support was this time round at around the 38.2 before retracing higher and then finally smashing through all the other levels. You can clearly see here as it smashed through 38.2, 50%, 61% offered no support. Where it did find support briefly was at around the 78.6% Fibonacci retracement. All right, you can clearly see how the retracement levels help us to identify potential, right? The key word here is potential support levels or potential resistance levels, right? Nothing is set in stone. It doesn't mean price has to react off each level, but it's just helping us to identify potential support or resistance levels. Okay. Now, After price has come down here, it has found support around 100 and 190 before proceeding higher. So now we have 0.2 and 0.3. We can also run a Fibonacci retracement on this downturn. So we'll start from here, 0.2, 11th of December, going down to 0.3, which is the 14th of December. So in this case here, we can see as price was retracing higher, these retracement levels are helping us to identify potential resistance areas or zones, but we can clearly see 23.6% offered no resistance. Where it did run into resistance was around the 38.2%, right? 38.2% was where price found resistance before dropping lower. And you could see from 18th December all the way till 3rd of Jan, right? This price failed to break above this level until just recently last week. Okay, so this is how we can use the levels here. Now, as price comes down here, right, we can see now this, I would use this as let me highlight this as 0.4, right? So you can see here, this is a pretty significant swing high. This is a significant swing low. So if I were to extend this Fibonacci retracement, right, I go from 2 to 4, right, we can see that the market structure, the trend line has captured the market structure quite well, right? Quite well. Some would argue that because this has drifted too far, I would not use 0.2 as a starting point, but rather I would try and use 0.3 here, for example, this point here. Okay, here the market structure, the trend line captures the market structure a little bit better, but even here, I think to me, this is still pretty all right, right? This is still pretty all right here. You can see at this part, especially the beginning of the move, the trend line captures the market structure very well. And the second half of the move, it captures it pretty well as well. It's only this bit here. So as price is retracing higher, we can see clearly 23.6, 38.2, and 50% retracement levels offered no resistance at all. Where it did run into resistance was around the 61.8% Fibonacci retracement, right? So you can see here, these retracement levels are just going to help us identify potential resistance, but you actually have to see where price is actually going to run into, right? So you can see here, because this is also an overlap, a pretty strong resistance level here, right? As price retrace higher here in 18 December, this forms a pullback resistance, right? This forms a pullback resistance level. And you can see price actually running into resistance here on 3rd of Jan, right? It broke above 23, 38, and 50 very easily, but it actually stalled at around this resistance level here at 102.64. And also we can see how the 61.8% Fibonacci retracement has also helped us to identify another strong resistance zone above this pullback resistance. Okay. And now, okay, I'm going to label this as 0.5. So in this case, I'm going to run the Fibonacci retracement from 0.4, this swing low, ending with this high here at 0.5. Now, as price is, let me get rid of this. Right, now as price climbed as high as or briefly going above 103 and then pulling back sharply, you can see that as it was falling down, 23.6% offered no resistance. 38.2 is a level where we did find a little bit of resistance, right? But actually, you can see it actually go beyond. So where it found support was slightly above 50%, right? So the major support for the dollar index now is actually at around 102.10. And we can also see that 50% is also still suggesting another strong support zone should price break underneath 102.10, right? So do take note, these are the key support and resistance levels okay, of course, now with price breaking above it, I would have to adjust my resistance to this level here. I'm going to use the body of the candle so we can see the major resistance at 102.74 and major support at 102.10. All right. So so we've covered Fibonacci retracements today, which is part 1 of the Fibonacci series, masterclass series, right? So do look out for part 2 coming up next week, right? So where we will be building on retracements, right? We covered a little bit of extensions and Fibonacci expansions today as well. Do take note, expansions are the negative levels and extensions are the levels greater than 100. We covered a little bit of that as well. And in part 2, we're going to delve a little bit more deeper into them. All right. So just to recap, today we had Fibonacci retracements. Do remember we're looking out for significant swing highs and swing lows, right? Such as these, right? We're looking out for significant swing highs and lows. Where did it go? Where's my brush? Right. Such as these, right? This is a significant swing low. This is a significant swing high. Another significant swing low. Also another significant swing low and swing high. So do take note. It is important to identify a good or ideal market structure where we can clearly see the significant swing lows and the significant swing highs, so that when we draw the Fibonacci retracement tool, we're actually going to get indication that these retracement levels are going to offer significant support or resistance. And do take note that the trend line has to capture the market structure as closely as possible. All right. Okay. So we've come to the end of today's webinar. Thank you all for tuning in. Do look out for next week's Fibonacci series part 2, right? And do register for that as well. All right. Take care. Have a great trading week and enjoy your weekend as well. All right. Thank you, everyone. And I'll see you guys next week. All right. Take care.